Hey, what's going on, guys? This is Alex Cook. So I got a video, and I was originally going to make a video on a different topic, but this is a story that's just too important for me to pass up. So you may have seen that the yield curve has now inverted, and I'm going to talk about what this means. I'm going to talk about what the yield curve is and what we could do about it as investors. So bottom line up front, this is pretty much a 100% chance of recession. And I will use terms like that. Like, I'm going to rip the Band-Aid off. You may see news articles saying that, oh, it's not that big of a deal. Well, just look back historically. Every time this has happened, about 12 to 18 months, you see a recession. All right, so what is the yield curve? And then I'm going to talk about why it's important. So what the yield curve is you take interest rates on different tenors. So there's bonds that trade out to 30 years. In this case, we're talking about treasury bonds, all the way down to 3 months. And then you just make a graph. So just get a graph and just plot, all right, the 3-month one is this percent. 2 years is this percent, so on and so forth, all the way up to 30 years. And it will make a curve. It'll make an upward sloping curve under normal conditions. So what that means is that normally longer term rates are higher than shorter term rates. All right, so this may all seem kind of technical at first, but bear with me. I'll explain why it's important and how this works. So the reason why normally longer term interest rates are higher than shorter term ones is because over a longer time horizon, more weird stuff, more uncertainty can happen. Like, let's say between now and the next 10 years, like, who knows? Maybe we go to war with everyone at the same time all at once. Maybe we get hit by an asteroid or whatever. So interest rates are usually higher because there's more uncertainty, more risk, more weird things can happen between now and then the shorter term, where we probably have a more clear idea of what's going to happen between now and a shorter time horizon. So when the market has shorter term interest rates higher than long term ones, that is a very, very, very strong signal. That is the credit market telling you that, hey, there is something serious going on right now, even to the point that we think over the long term, it's probably going to get better. Like, the long-term view is probably going to be better than what it is right now. Now, things don't happen all at once, though. So what happens is when credit slows down, it takes a little while for that to actually hit people, because it takes time for them to feel it, as far as, oh no, I really do need to pay off my debt. I really do need to cut back on spending. And same thing with businesses. So it doesn't happen all at once, but it is a pretty reliable indicator that about 12 to 18 months, you do see an economic slowdown. Now, I want to be very clear, though, that when I sometimes say this, like when I use terms like recession, people think I'm talking about a 2008 crash. No, that's not what I'm saying. 2008, that easily could have been a depression. That was a serious, very serious crisis. Just recessions, like, honestly, these things happen. Like, they're not pleasant. No one enjoys it. No one enjoys getting laid off work, but the reality is these things happen about every 7 to 10 years. It just, credit expands, credit contracts. It's a cycle. So what to do about it now, knowing that this is probably likely to come? So you're going to hear a lot on the news, a lot that's political, so you know it's BS right off the bat. And you're going to see some that's just bad opinions, but you're going to hear a lot of things about, hey, what should the Fed do? What should, this and that do? Look, I don't control any of that. I don't control what the Fed does or anyone else does. The only thing that I have absolute control over is what do I do with my finances. And that's the way I suggest you look at it. So here's what we can do. First of all, this is not the time to be wilding out on credit. All right, this is not the time to be getting a freaking second home equity loan, freaking, taking out a second mortgage to buy a Litecoin, which there's a true story behind that. I've heard someone that actually did that. Now, they actually made money because crypto was going up at the time. But the point is, this is not the time for the crazy stuff. All right, that time is past. That time is past. Now, it'll come again. It'll come again. We will have another bull market eventually because, these things go in cycles. They go up and down. But this is not the time for the crazy stuff. So what this is the time for, pay down debt, build up some savings, maybe move a little bit more conservatively with your investments, maybe a little bit more bonds, maybe take some of the riskier assets a little bit off the table, and then build that war chest. Get your own footing solid, first of all. So if you have debts, take care of that now before an actual slowdown happens, and then you get screwed. Like, handle yourself now before it gets to that point. That's what I'm trying to say. So you build up your war chest, and then after the recession hits, Once things are bottomed out, once everyone is panic sold, when people are freaking out, this is when you step on the gas. That is when you step on the gas with the war chest that you started building now. So again, what you got to realize, these things happen in cycles. There's going to be a recession someday, maybe 12 to 18 months, maybe later, but it's going to happen. Look, I'm not God here, okay? I can't just turn the recessions off. Like, I don't have that power, all right? I just work here. So all I can do is control my own investments. So the way I would suggest is you realize these things happen as part of a cycle. You plan accordingly. You build that cycle into your plan and realize right now maybe on the downslope. So you get ready for that and then get ready for the upcoming upslope. So hope you found that informative because there's going to be a lot talked about the yield curve. It is a very important indicator and it is a very strong indicator. So if you enjoyed this kind of content, click subscribe for more. Check out my website. And if you have any questions, leave a comment. I like hearing from you guys as far as what you find interesting. And thanks for watching.